So I'm going to bring you through very quickly just an update on Ireland, and just to reiterate, just like Neophytus said, Ireland has no plans to leave the EU either. We did leave the UK 100 years ago, and that worked out okay, but no plans to leave the EU. So the Irish economy, Irish business environment at the moment is doing quite well. Corporation tax takes are up. There's a huge amount, we're back. We had a tough recession, but we've survived it. Unemployment is coming way down. There's a huge amount of optimism in the country, and there's a huge amount of ambition. So business is doing well, whether it be foreign businesses that are coming to Ireland or indigenous business. So I think it's fair to say we're booming, and hopefully that'll last. The one headwind that we're worried about is Brexit. And the first thing I'd say about Brexit is that it's already happened in Ireland. Very quickly after the Brexit vote, the sterling devalued, and that had an immediate impact on some industries in Ireland. So, for instance, food sectors, which had very low margins, selling exclusively to the UK. Some of those businesses closed down after months because they were just making losses. It was unsustainable. So Brexit is here in Ireland, and we're already dealing with it. And I guess if Brexit is a divorce between the UK and the EU, and the 40 or the 50 billion number is the alimony payment, the child that's been used as a pawn as part of the negotiation process is probably the border between Northern Ireland and Ireland. And that has significant economic impact for Ireland and Northern Ireland and the UK, but more importantly as a political and security impact. So I think the sooner that one gets sorted out, the better. Any solution will do as long as it's reasonable to all parties, and that it's stable and there's a certainty around it. So that's what's happening. But other than that, Brexit is an opportunity. We're now, as Patrick alluded to, we're English speaking, so we're the only English speaking country in the Eurozone and shortly to be in the EU, and we're well poised for some of the post-Brexit companies that if the UK isn't the answer for them, Ireland is one of a number of options, but it's a good option. So that's where we're at in Brexit, and that's probably the main headwind in Ireland at the moment. But other than that, I mean, it's no news, but it still is news in a way, is that 12.5% rate is still there. It's a robust rate. It's a consistent rate. It's sustainable. And, it's a reasonably priced tax rate, I suppose, which has been in Ireland for a long time, and it's going to be there into the future. So that's probably one of our main selling points still. It's a very simple message, but it's consistent and it's robust. Holding company benefits, I mean, there are a couple of pointers there in the slides, and rather than go through each one of them, because you're probably aware of the ideas there, and a lot of them are common themes for other regimes around the EU or around the world. But I suppose the net take-home point is that it's a competitive regime in that space. It does a lot of the things you'd expect it to do, and it's been tweaked over the years, and it works. Some of the things that are there, like no CFC rules, well, with BEPS and with that's going to change in the next couple of years. The certainty around how it's going to change, we don't really know fully yet, but it is going to change. So some of those, I suppose, advantages will be chipped away at in the coming years as part of BEPS. And transfer pricing, whereas obviously Ireland being a relatively low tax jurisdiction, transfer pricing isn't a huge concern. Or transfer pricing rules were transfer pricing light for a number of years, and it only related to trade. They didn't relate actually to non-trade activities, but that's going to change in the coming years. So that's been tightened up. So some of the things we have are changing going into the future. Some of the other things, I suppose, that there's no point in just talking about the positives. I mean, you need to learn a bit about the negatives, and some of the negatives are our personal income tax rates are too high. So for businesses looking to go into Ireland, telling the executive they're going to be paying 52% income tax is a bitter pill to swallow, and it's not good. Now, you can tweak that. We have a remittance basis, and we have a SARP relief, which sort of discounts the top rate of income tax by 30%. But at the same time, it's a relatively high tax rate. It's a relatively high expensive country to do business in. And our housing situation at the moment, especially in Dublin, makes there's a huge shortage of housing. So for businesses locating to Ireland, let's say the banks post-Brexit, that sort of thing, it's a real concern. So that's something to be mindful of and be aware of. But BEPS is definitely part of the mix. It's definitely had an impact, and it's not just BEPS actually. It's BEPS and the fear of BEPS has changed our rules. It's changed clients' views on what they can do. It's changed the appetite for risk, and it's changed sort of everyone has figured out now that what works now won't necessarily work in the future. So we've introduced a number of things, country by country reporting, and we were one of the first countries to where some of the knowledge boxes were reviewed, and a small number were considered to be harmful, and another number of them were sort of tweaked as a result of that. Ireland introduced a knowledge development box, which is basically a 6.25% rate, and that came pre-packaged with OECD approval with the modified nexus approach. So that's there, and it's sort of it's BEPS friendly, I suppose. The MLIs are coming in, and those changes are going to have an impact, and ATAD is having changes on the Irish rules. Although a lot of the ATAD changes were actually a little bit like the UK, we were already compliant. So the ATAD changes are actually no new news. It's just we're already at the good practice. So, and it's not all tax. We have a good infrastructure. We have a stable political system, and we've got huge talent. The talent, the people to do the business, if and when you come to Ireland, are there. And the last thing on BEPS is the government is taking a very transparent and sort of a proactive approach. And they recently issued what's known as the Coffee Report, which, thank you, which was an analysis of how BEPS is working out. And it just underlined the fact that we want to be competitive in the global tax scene, but we want to be transparent. We don't want to favour any particular companies. And we want a consistency in corporation tax rates. We're not looking to spike corporation tax. It's just for it to be consistent going forward. So that's what's going on in Ireland. And briefly now, I'll talk about just something a little bit specific. Ireland is an IP location. What are the benefits? So the first one I would say is, forget the tax. It really is about the talent. You've got the scientists and the engineers who can do what you need to do, people with regulatory experience, and they come from a number of places. There are people on the ground who are working in the industries which are well established in Ireland. The second place you'll find people is it's relatively easy to hire people from abroad, non-Irish people, to come to Ireland and work in industries because it's an attractive place to live and work. And thirdly, there's a huge expat population of Irish people abroad, whether they're working in the pharmaceutical industry or engineering or Silicon Valley, and they're keen to come back to Ireland maybe at a certain time in their life, and then they're a good source of talent, if that's what you're looking for, if you want to use Ireland as an IP location. But then again, I suppose what we have basically is we have a number of reliefs that are targeted at IP that work, and they make Ireland an attractive location from a tax point of view. We have an accelerated capital allowances regime, so even if you bring in IP from abroad, from a related company, you can write off that IP over a short number of years, and that's attractive. I'll come back to substance though. You do need substance in Ireland, and that's a thing that has been consistent with Ireland's approach. So let's say even with the famous Apple case, where there's an argument that Ireland was used as a conduit, that wouldn't have worked unless Apple had substance in Ireland, and Apple has thousands of people actually working in Ireland. So it's not about a letterbox sort of situation. It's the same for the IP. We have a long-standing R&D credit, which basically gives you 25% back as a credit on your spend on R&D, and it's quite a generous relief. But what's useful about it is that you get a refund of payroll taxes if you're not making any corporation tax profits at the time, so you actually get real cash flow benefit when you need it most. And we have the new knowledge development box, which I talked about. It's the modified nexus approach. It's because of BEPS, it's probably not as good as we'd have liked it to have been. The qualifying assets are a bit restrictive. It tends to be copyrighted software and patented products or patentable products. and if we didn't have BEPS, we would probably been wider written. But it's there. It's a good rate, and it's very attractive. It's a very attractive regime. And once you make the profits, Ireland is a relatively good country. If you want to give dividends out, if they're going to a treaty country, the domestic rule actually does better than the treaty rate at 0%. So there's some of the a view on why Ireland is a good location for IP. It's attractive, and it does there are a lot of good tools you can use if that's a location that you or your clients are interested in. Thank you.
Thank you very much. Maybe one or two questions from the audience or the panel. I think time is running out, but we have, go ahead.
Sometimes as an American, I try to make sense of the EU, and especially with the discussion on Brexit and Ireland. So on the Apple case, where there's hundreds of millions of dollars overseas, but under the repatriation tax, if it goes into effect, if Apple has to pay tax to Ireland, the Trump administration, the United States, doesn't get the tax revenue that they think they're going to get because it'd be a tax credit. So what is the current thinking about what's going to happen to that case in Ireland or the EU with respect to whether or not Apple is actually going to be liable for additional taxes to Ireland? And then my other question is, since technology is the future, basically, and my understanding of the EU is that this Apple legislation, Apple case, didn't come up so much through the tax side of the EU, but through the anti-competition subsidy side of the EU, imposing a result for taxation, which, going back to Brexit, if the UK is no longer part of the EU, and therefore they're not subject to the non-tax, let alone the tax regimes of the EU, does that give them an advantage as far as the possibility of technology and R&D moving from Ireland, for example, to the UK, because all they have to worry about is tax legislation and not anything else from the EU that could possibly impact tax results and certainty?
Yeah, I suppose there are a couple of things there to unpick. The Apple case, you asked a good question. It is confusing. I think the only way of understanding the Apple case is it actually isn't about tax, and I don't think it's even about competition. It's about politics. And that's really, if you look at it, that's the motivation behind it. They gave technical arguments that, what Ireland was doing, it was aware that Ireland was being used as a conduit, and therefore, the way Ireland treated it, what was anti-competitive. But as it happens, the case that they're using happened years after Apple was using its regime. And I think, what way will it go? I think the thinking in Ireland is that the Apple case the Commission is going to lose the Apple case because any other result wouldn't make sense. It's a funny one, though, because the EU is acting as a bully in this case, really, and they're bullying Ireland. Although I remember when I went to school, what happened was the bully was the guy who took the money off you. He took your money off you, and he used it to buy his lunch. In this case, the EU is trying to take the money off Apple and give it to Ireland, which is, it's nice that bullies have improved since I was a kid. The other thing is your question about the UK. Would the UK be at an advantage being outside the EU? I think so, yeah. I mean, I guess that's one of the motivations behind the UK leaving the EU. The EU was considered to be a straitjacket, and the UK couldn't be flexible and do what it wanted, not just in tax, but I suppose in other areas. And so, yeah, that is an advantage, definitely, for the UK leaving the EU. But I suppose the argument is more complex than that, because there are advantages being within the club as well. So I think that's how it's panning out. Oh, it's 2 or 3 years down the line.
Sorry, could I ask one question as well, please? Here at the back. Waving at you.
Yeah, please go ahead.
Firstly, thanks to the speakers, very informative sessions. There's been a lot of discussion around corporate taxes, holding companies, Brexit, things like that. Be curious as to what the panel view is, and if all the panel could comment on what are the other sort of initiatives around taxes. Donal has mentioned that personal taxes in Ireland are probably on the high side as opposed to a low corporate tax environment. So what are the initiatives that are out there or potentially planned over the next while around other taxes, particularly personal, even things like sales taxes, etc.? So I don't know, Donal, if you want to kick off with that.
Yeah, I suppose certainly in the personal tax, the personal tax scene, is that SARP relief, which has been around a while now, but it's been improved every year. So what that does is it gives a discount on the top tax rate if an executive or if an employee is coming with their company into Ireland. So it's the sort of personal bit of the foreign direct investment. There aren't actually, it's consistent, lobbying groups are consistent in asking for more reliefs in that regard, and sort of putting, so giving an enhanced SARP relief. So I think that we would hope that's coming down the line, but I can't be sure if it will. But some of the other tax reliefs are sort of, Ireland has sort of, and it goes ultimately to the personal element again, is we have an entrepreneur relief, which in the moment, if you build a business and if it does certain things and you hold on to the business for a certain amount of time, you sell it, rather than paying capital gains tax at 33%, you'll pay capital gains tax at 10%. At the moment, it's 10% to the €1 million, but it's probably going to go up to 10% on a much bigger number than that. So that allows sort of the entrepreneur to know that at the end of the day, if and when they crystallise their investment and their hard work, that they'll pay a very low tax rate.